Hey, Professor Money here. You know that money is my brand, so welcome back. You've probably heard a lot about stocks and bonds, but do you really know the difference? Let's start with bonds. Bonds are basically simple investments that are safe and are really nothing more than good old-fashioned loans that have to be paid back by a company to you with interest. So if you buy a $1,000 20-year bond issued by McDonald's, that means you lent $1,000 to McDonald's, and in 20 years, McDonald's has to pay you back your $1,000. Of course, they also have to pay you interest on the $1,000 you lent to them, which is the reason you lent them the money in the first place. A bond is a safe loan you make to a company, or the federal government, or a state and local government, to earn interest. They are typically safe investments that pay you a steady interest stream that is a legal obligation of the borrower to you. In the event they don't pay you the interest or the principal you lent to them, that is called default, and that allows you, the bondholder lender, to seize the assets of the bond issuer, the borrower, in a bankruptcy proceeding. Bonds are intended for older people or people who want a stable, predictable income stream. In general, bonds are safer than stocks, but they also tend to provide a much lower return, about 6% annually over time, compared to about 12% for stocks. Other than defaults, which happen rarely, bonds also come with interest rate risk. That means when we have inflation and interest rates rise because of the value of inflation, the value of bonds you already own will go down. So bonds are not a good inflation hedge. You'll need stocks for that, and we'll teach you about stocks in our next video. Until then, tell your friends about Professor Money and keep all those likes, follows, and subscribes coming. And let's get richer together.